Tom Bowley, Chief Market Strategist here at EarningsBeats. Hey, good morning, everybody, and welcome to this Tuesday, January 30th, 2024 edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I will be with you here for the next 30 minutes or so as we prepare for yet another trading day. January starting to pick up here as we close out the month. Yesterday, very strong rally into the close, lifting a lot of areas of the market, especially the S&P 500 now at a new record high. Really, a lot of the strength came in the last couple hours of the trading day yesterday as we turned straight up. We had a big AI report out after the bell yesterday, super micro computer SMCI, really big report. Not only blowing away estimates, but a significant guidance raise in terms of revenues. And that really lifted a lot of the AI stocks into the close yesterday. So pretty good action there. But I'm going to go ahead and jump right in. And let's see if we can get into the recap from Monday to start the week. So we had the Dow Jones Industrial Average finish up 224 points. That's at 38,333 now, so clearly above that 38,000 level. That was yet another psychological round number to get through. S&P 500 up 37 points yesterday, another 0.75%, 49.28. I know back in November when things started to take off, I was getting a lot of questions about, how can you get in now? After the market's made such a big move, how can you get in now? In a secular bull market, it takes no prisoners. It just continues to rise. One thing I've said about a VIX that, habitually stays down below the 17 to 20 area, and especially as it gets down into lower teens and maybe even in below that, we get a lot of boring action. The market just keeps going up day after day after day. When we do see pullbacks, they're short-lived. And that's really the environment that we've been in here over the past few weeks in January anyway, and certainly maybe even back into December. But S&P 500 closing 49.28. That was the first close above 4,900 for the S&P 500. And talk about round numbers, 5,000 now within reach of the S&P 500. Who would have thought that about a year and a half ago? NASDAQ 100 up 1%. That was up 175 points to 17,596. Getting close to the 17.6 area, also close to another new all-time high. The mid-cap index up 25 points. That was almost 1%, up about 0.9%, starting to turn back up. I'm watching the AD lines on both the mid-caps and small caps to see if we get a little bit more of a turn to the upside. Mid-caps faring a little bit better than the small caps. But yesterday, it was all about the small caps. Small caps rose 3.4 or $3.43 to that was about 1.75%. So clearly a lot of relative strength in the small caps yesterday. And there's nothing wrong here with the chart, by the way. A couple of things that I had laid out was maybe that we would see an inverse head and shoulders after we got the pullback and the push back to the upside to about 198 or so. Said, well, maybe this is going to play out like a cup. Maybe it's going to be an inverse head and shoulders. But when I'm seeing an uptrend, I look for continuation patterns. And so the IWM, in my mind, looks like it broke. And I'll show you this on a bigger chart in just a couple minutes. But it looks to me like it broke this inverse head and shoulder neckline pattern yesterday, which would be a really nice bullish move there. Transports, not really participating as much. Still trying to, get a breakout on the transports. That's been maybe one thorn in the side of the bulls, is not getting that continued confirmation from the transportation stocks. And if you're in the camp that thinks we're going to have a stronger economy, there's no reason to hold back these transports. So I'd like to see the breakout here. We're up 34 points yesterday, which was about 0.2%. But a lot of times you'll see the transports move with the small caps. We didn't really see that yesterday. So this is a group I continue to watch. Discretionary leading all sectors. When was the last time I said that? It's been a while, because Tesla, which is such a heavy weighting in discretionary, hasn't had a good day in a while. Well, yesterday Tesla had a much better day, and therefore discretionary stocks finally rallied a bit. We saw the group up almost 1.5%, rising back up above 174. The 20-day moving average was at 173.95. So we did beat that by, I don't know, maybe about 30 cents or so, 25 cents. So we did get back up above that 20-day moving average and also the 50-day moving average, which was 173.54. So this is the area where I really would like to see the XLY start to make another push back up toward that December high. Got a long way to go there. Technology, another strong day in technology, rising 0.9%. That takes us back up above $203. Still got a little work to do to take out the high, just like on the NASDAQ 100. But overall, can't really argue with this uptrend technology has been in. Communication services rising a little bit more than 0.8% yesterday. It has been a straight up move. The communication services sector, if you read my monthly seasonality report, which, by the way, the February report, I'm hoping will be out today. I've been working on that. So I should have that out later today to give you a little bit of heads up as to what we might expect in February. But if you read the January, you know communication services was the #1 sector in terms of January performance, and it has certainly lived up to the hype. Huge move up in the XLC here, especially over the last couple of weeks. XLC yesterday up another 0.8%, jumping above the $78 level. Really strong area of the market right now. So looking at many of those internet stocks. And as you'll see in 1 second, media agencies strong yesterday. But first, let's talk about those automobiles rising 3.8%, 25 points. I mean, you can see, you look at almost any other chart, we're basically going to higher highs, higher lows. Look at autos. Autos have been absolute, I don't know what to call it, just been trash for the last month or so. And most of that because of Tesla, but also all the other many of the other autos doing poorly as well, especially in the EV area. Rivian, Lucid, some of these other stocks, but Tesla, the primary one, driving automobiles lower. Finally, we got a little bit of movement yesterday back to the upside. I know earlier in pre-market action, we had I know Tesla was up another $4 or something. So maybe autos are trying to put in a bottom. Maybe this is going to be a gap up that leaves those last few candles on an island. That would be an island cluster reversal. Don't know, but maybe. We'll see what kind of reaction we get. If we do get a gap up, do we see that continued buying? If so, that could easily be an island cluster reversal, which would be good for the autos. Media agencies, as I mentioned, big day there, rising more than 3.3%, nearing the high we saw back in December. So a good move here. And then finally, recreational services. After going down, testing that 50-day moving average, moving close to some recent lows down around the 96, 97 area. Big jump yesterday on recreational services, rising more than $2, back above 101. That was a 2.2% climb. Really nice action in that area. And if you notice, two of these three right here, part of that XLY, part of the consumer discretionary group. So maybe, just maybe, we're seeing a little bit of a turn there. Moving on to the 10-year Treasury yield, we did have a couple of reports actually that were just out, economic reports, that is. Let me give you a quick update here. Looks like we're rolling over. We got a Fed meeting coming up on, starting tomorrow. We'll get the Fed policy statement out at 2 p.m. on Wednesday. But we got up to that 420 level, which I thought was going to probably be the area of resistance. We seem to be rolling over. And for the first time since hitting 420, we are opening back down. The yield is opening back down below both the 20 and the 50-day moving average. So it certainly gives that appearance of wanting to roll over here. Not sure what the Fed could say maybe to boost that to the upside, because it's hard to argue with the numbers, and inflation continues to drop. The economic numbers for the most part have been tame. We did see GDP coming in a little hotter than expected. It'd be interesting to see what the Fed has to say about that. But I just don't know that there's enough evidence out there for the Fed to keep talking about any rate hikes. In fact, last month when they met, they talked about raising the number of potential cuts that we would see in 2024. So my guess is that once the Fed comes out, we're probably going to see more folks jumping back into bonds, sending those yields lower. That would be my guess. An educated guess, but a guess. So we'll see what happens there. But right now, still consider that 380 area, maybe down to about 378 or so. up to 420. That's the current range for the 10-year Treasury yield, but it does, at least now, it appears to be rolling back over again. Let's take a look at that the economic reports, because the Case-Shiller Home Price Index came out about 10 minutes ago, was expected to rise 0.4%, but it only rose 0.1%. So a little bit of weakness there in the home building or home construction area, home prices. I think there was one other report. Yeah, the FHFA House Price Index came in as expected, rising 0.3%. But that's it for the economic reports today. Earnings are definitely starting to pick up, and we'll go over a couple of those in just a few minutes. But Thursday's the big day. Thursday, we have Apple, we have Amazon, we have Meta. I believe we have, no, I think Starbucks might be later today. I'll look at that one. But we do have a lot of big earnings reports coming out on Thursday. The market seems to be pricing in some pretty good numbers in terms of these big companies. The Magnificent Seven still seem to be on a roll. And again, yesterday, SMCI came out with a big report in the AI space. That is not going to hurt that group at all. Looking down the road on these economic reports, we do have the ADP employment report coming out tomorrow. On Thursday, of course, initial jobless claims, productivity, and costs. A couple manufacturing reports, and then Friday, the non-farm payrolls. And right now, the expectation is for non-farm payrolls to come in at 170,000 jobs. The prior month was 216,000. So looking back to December, 216,000. We're looking for that number to be positive, but to drop a little bit. And I kind of view that as nirvana based on what the Fed, if you're thinking the Fed is going to continue to be more and more dovish, you want growth, but you want slow growth. At least in my opinion, that's what you want. And that's what we're calling for this Friday. We'll see whether or not we get it. One would imagine that the Fed, when they make their decision on Wednesday, will probably have access to those numbers. And we'll see what happens later this week. Let's see. What else did we have for this morning? Well, I guess I can give you the futures for this morning, which, by the way, are lower. Not by a lot, or they weren't, but let's go over the major indices. The diamond, of course, tracking the Dow Jones 30. That is down 0.2%. After gaining about 0.6% yesterday, so giving back roughly a third. The Spider, which gained 0.8% yesterday, down just under 0.2% today, so that's given back about a quarter. The QQQ, which yesterday was up little over 1%, 1.02%, down $1 this morning to 427.16. That's giving up just a little less than 0.25%. So again, about a quarter of the gains from yesterday. IWM falling a little bit more, down almost 0.5% after rising 1.75% yesterday. So that's given back maybe a little less than a third of what it gained yesterday. But the IWM, which closed at 199.41 yesterday, trying to get back through 200, did manage to fall back this morning to about 198.46. Again, that's down almost $1. So that's what we're seeing right now in terms of futures. So let's keep moving on. S&P 500. You can see right there, big move back to the upside again. And one thing I've talked about is one reason to be maybe somewhat cautious in the near term is we do have a negative divergence on this chart, and it's still there. You can see we've still got a negative divergence, higher highs, and then lower highs over here on the PPO. So price action moving up, the PPO still negative, but when you break out with a negative divergence, as I talked about, you don't know how far the rally is going to go. We still don't know how far this rally is going to go. And it's very possible now that the PPO is turning up and moving higher, if we keep going up for another 2, 3, 4, 5, 6, 7 trading days without any kind of reversing candle, without much of a pause, it's very possible that PPO goes to a new high and eliminates the negative divergence. So again, Negative divergences they are not your primary indicator. A lot of traders see a negative divergence and think, oh, market's going to come down. It may, but you've got to see the price action reverse. Price and volume, number one indicator by far, in my opinion. So you look at divergences, you might look at overbought indicators. A lot of people keep throwing out, oh, market's so overbought. I can't get in. It's not going to go higher. It's too overbought. Secondary indicator. Price volume is telling you a different story right now. Until we get a reversal, market looks like it wants to go higher. NASDAQ 100 didn't quite make a new breakout, but probably one of the more bullish days in the last 6 days, because mostly we've just been seeing gap ups and not really a whole lot else after that. But yesterday in the afternoon, if we look at a 10-minute 5-day chart, you can see, especially in that 3 o'clock hour, that was where we started getting a lot of the strength. I mean, we bottomed back in the morning hours, which is typical during a secular bull market to go down in the morning and then rally in the afternoon. Well, we have a poster child right here from yesterday. Big move up in the afternoon, especially into the close. Now in the morning today, we're seeing futures lower again. Let's see what happens after perhaps a little bit of morning weakness. IWM. So let's take a look at this chart I was talking about. And I'm going to shorten it just a little bit. Let's go with a 6-month chart, and I'll annotate what I was talking about earlier. So first thing, in order to get a continuation pattern, you've got to have a trend. You can't have a continuation of a trend if you don't have a trend to begin with. So the first thing you have to have is a trend. And I think from the end of October through the end of December, I think that's clearly an uptrend. You can feel free to disagree if you want, but I'm going to like winning this argument because I see higher highs and higher lows. I see a really nice uptrend in play. So that's step one. You got to have an uptrend. Once I see that and we start to get a pullback, I start to look for continuation patterns, primarily because I'm bullish and I believe the market still wants to go higher. Yeah, are there short-term signals, cautious, be careful? Sure, negative divergence I pointed out, but we need to get that. We need to see a reversing candle before. Here, in the case of the IWM, there is no negative divergence. Number one, at the latest high, the PPO is at a high. So normally what we see is a pullback to the 20-day. That's what I expected. I expected the IWM to bounce off of the 20-day. It kind of rode the 20-day for a little while. And then on a couple gap downs, went down basically to the 50-day moving average, PPO all the way back down to the center line. So essentially we got what I call reset. Anytime the momentum gets back to zero, you've already squashed out all the momentum. So even if we go back up here and set a new high and you see a lower PPO, that's a negative divergence by definition, but one I ignore because I'm coming off a center line test. Think about what the center line is. Center line is two moving averages, one a little bit shorter term than the other, and they're at the same level. The PPO is the difference between whatever two moving averages you use. The default at stock charts is a 12-period and 26-period EMA. So they're exactly the same when you get the PPO at zero. There is no momentum. So forget about a sign of a slowing momentum. You have no momentum when you get to zero. It doesn't make common sense for me to talk about when we get back to a new high, comparing it to the momentum over here. When price gets to a new high, who cares? We're starting from zero. And when you start rising from zero, the bullish momentum is accelerating again. You're looking at two different periods of time, which I think, you got to decide at some point, when do you start over? Because if you look at like a monthly chart or maybe even a weekly chart, but definitely a monthly chart, we set a high on the PPO and that on the NASDAQ back in 1999, 2000 that we've never gone through. Have we had a negative divergence for 24 years? Or, well, it wouldn't have been 24 years because you don't get one until you break out. But probably for the last 10, 12 years, we've had a negative divergence technically on the NASDAQ. I can show you that in just a minute. But anyway, what I'm seeing here is a move down and potentially a move back up to set a neckline, a new low, and then a move up to potentially set the right side of a neckline, which is upsloping, which I like because that's telling you that you've got a little bit more momentum. You've actually taken out that prior reaction high. That's bullish. The last bounce only got up to about 197. This bounce was up to about 198.5. So that to me looks much more bullish. Also, when you pull back and establish an inverse right shoulder, notice the right shoulder is on the 20-day moving average and above the left shoulder. So you have this neckline that seems to be moving higher, which I like, a rising neckline as opposed to a falling neckline. And they're not always exactly even. So I like the ones that can get up and take out previous highs because it just gives you a sense that resistance has already been cleared, at least part of resistance. Anyway, we went back at the 20-day, and yesterday we made a nice move up and cleared this neckline. So that to me is pretty bullish. The other thing that I had talked about was perhaps seeing a cup form, which I guess technically we could still be in a cup. You know, I mean, this could be still a cup. Not everybody's going to see an inverse head and shoulder here. Some traders could be looking at this as a possible right side of a cup that's forming. In which case, probably if you get up to 205, we're going to see a pullback, which would represent a handle. But regardless, what I see as an uptrend and what I see over here is what appears to be a continuation pattern forming. Pick one. Inverse head and shoulder, cup. We're not quite high enough to really even start talking about a cup just yet, but it does look like potentially that kind of a pattern. And either one of them are bullish. Both of them are bullish. So we break out above 205. I've said, you know, I think the small caps could have a really strong year. And the fact that they've been lagging so far in 2024, I think a lot of that could be attributable to the fact they're in a consolidation pattern. When you're consolidating and the other indices are not, you're going to see relative underperformance. So it's going to be very interesting to see if the rest of this pattern plays out. And if we get a breakout, what happens to that relative strength versus the other indices. That is something to keep an eye on here over the course of the next few weeks. All right. Not sure why I pulled up the 10-year Treasury yield there. But anyway, let's move on. So we're going to get into the chart of the day. But first, before I get into that, I do want to talk about, earnings beats. For those of you who are new to earnings beats, welcome. We certainly appreciate you tuning in and supporting us here through our YouTube channel. While you're here, make sure you hit that subscribe button. We'd love to have you return. We do these shows Tuesday, Wednesday, Thursday, every morning at 9 a.m. Eastern. So you can find us at 9 o'clock just before the market opens. Also, if you're watching, please click the like button. That helps us as well with the YouTube algorithms. And if you really want to check us out, see what we can do for you, take out our 30-day no-cost trial to our paid service. Every Wednesday, we do a live trading room. That's coming up tomorrow at 10 a.m. after the regular show ends at 9:30. We do that. We had a nice winning trade last week intraday that we took during the actual trading, the trading room, which lasted probably a little over an hour. But we were able to bank one trade. We'll try and do it again tomorrow, see what we can do. Really hot right now in terms of earnings season and the acceleration. And so I think earnings and the way the stocks react to earnings sometimes can give us an opportunity to make a little bit of money. And that's what we did last Wednesday. We'll try and do it again tomorrow. But anyhow, 30-day no-cost trial. It does require a credit card, but we will reach out to you before your 30 days is up to make sure that you want to continue. We don't want you just getting hit with credit card, bills every 30 days if you're not interested in keeping the service. Also, if you're new to Earnings Beats, maybe this is the first time you've heard me, we do have a free newsletter. And if you scroll down, you'll see we have an Earnings Beats Digest, which is published Monday, Wednesday, and Friday, usually out before the market opens. Try to get it out around 8:30 or so. Sometimes you can blame me. I'm a little bit late getting that out. But for the most part, we do try to get that out in the pre-market hours. Very, very quick and simple read. Normally 2 paragraphs and a chart. So don't think about this massive newsletter that's going to take you too much time or whatever. Don't have time for it. Literally 2 paragraphs and a chart. If you spend more than 5 minutes on it, you're probably doing something else at the same time. Anyhow, check that out. It is free, no credit card required. You can unsubscribe at any time, but it'll help you learn some of the things that are important to us at Earnings Beats and the way that I evaluate the market, the way that I trade, my strategies. I think you'll get a lot out of that. And if not, all you do is hit the unsubscribe. Pretty easy. Let's take a look at the market, because what I wanted to do here is I wanted to show you a couple of companies that are going to be reporting on Thursday, and I want to show you their relative strength. And I can show you their relative strength to one another first. What is Google or what is Meta doing relative to Google? Well, if you look at the last year, you will see that Meta has been outperforming Google quite a bit. They're both internet stocks. Internet's been absolutely on fire. But if you're asking me which one do I think is the safer bet going into earnings, not the guaranteed bet. Let's be clear here. I can't give you any guarantees. I don't know what these companies are going to come out with earnings, but I evaluate risk. That's what I do. Everything I do is to evaluate risk. Now, I want to show you Meta. Well, let me go ahead and pull this chart up first. Just do Meta, and then let's have a relative strength. So here's the AD line on Meta. Here's the price chart on Meta. And check out Meta relative to the internet stocks. 52-week high right now. And check out internet versus the S&P 500. 52-week high. So I see nothing on this chart that's bearish outside of just being overbought. I mean, I think Wall Street is set up here and is waiting for a big report from Meta. Now, has it already gone up too much? Is it going to be a buy on rumor, sell on news? We've seen that plenty of times. It's very possible. That happens even with the best of reports. So when I look at this, I'm thinking good report. And that means even if it does pull back, it's probably a stock that I want to continue holding. I mean, if they beat their expectations and it's already a leader, why wouldn't I want to continue holding it, even if it did gap down? So I just feel better going into an earnings report. If I'm going to hold, I feel better about a stock like Meta. Let me show you Google, because Google, or Alphabet, has a couple of similar qualities. First of all, the AD line is soaring. Price action soaring. I mean, those two look almost identical. And if anything, maybe look at that breakout all over this base. So we based for several months before making this breakout. So there are some positives here on Google, but one negative that stares at me right in the face is Google relative to internet stocks has been going down and is near a 52-week low. Meta is at a 52-week high. So I guess my question is Alphabet or Google leading the internet space, or is the internet space dragging Google along for the ride? It certainly appears from this chart that it's the latter. I don't know if it's the latter, but it certainly appears to be the latter. And so I'm not saying Google's going to have a bad report. I don't know. But what I am saying is that I feel like holding it into its earnings report is riskier. Now, we might turn around and see Alphabet jump 10%, 20% with its earnings, and maybe Meta goes down 5, 10, 15%. I don't know what the answer is going to be. I'm just telling you from my own personal preference, if I'm going into earnings and I'm holding a stock into earnings, I would much rather be holding a stock that looks like Meta as opposed to Google. So hopefully that makes sense. All right. Last thing I want to talk about today, earnings. Earnings definitely picking up. SMCI right here. I'm going to pull that up. We'll come back to this list, but look at what SMCI is doing early pre-market, up $51. Yesterday, it went up 21 in anticipation. This stock was trading back in early December at about 250, maybe just above 250, early December. Here we are, the latter part of January, and we've more than doubled. This is one of those AI stocks a lot of people maybe haven't heard of. This thing's going up faster than NVIDIA. It's going up faster than a lot of stocks. Massive move in SMCI. And you can see market cap, 27 billion, as opposed to many of these companies that are up in the hundreds of billions or even in the trillions, getting close to there. SMCI on a relative basis anyway, trading much lower, but its revenue growth and its earnings growth are spectacular. And we saw another example of that last night after the bell. Other stocks, these are all stocks, by the way, that reported after the bell yesterday. any of them that are labeled 000 and then a number after it is, excuse me, are companies that reported after the bell yesterday. The ones that start with 1 are companies that reported this morning. So that's how I differentiate last night versus this morning. But right now, or momentarily, we're going to get a market reaction on both of these groups, the ones that reported last night and this morning. So at Earnings Beats, we put them all on one chart list. Last night's earnings, this morning's earnings, so that when the market opens, I can immediately see the reaction. So I'm going to come back to this in 1 second. But first, let's take a quick look at the market and see what's happening. We'll get rid of some of these other things. Don't really need any of these other tabs. All right. So right now, and we'll get a quick update, make sure we got the latest. So right now we got the Dow down 21, S&P down 2, NASDAQ down 25. Not much, seeing a little bit more weakness in the small caps, giving back a little bit more, maybe because they were up a little bit more yesterday. We'll see whether or not that strength that they had yesterday returns, though, after maybe some weakness here in the morning. But I want to show you now the earnings. So this is the beauty of this chart list. And it's free, by the way. If you're on the Earnings Beats Digest newsletter, our free newsletter, we give you access to these earnings chart lists for free. Where else can you get every company that has reported since yesterday's close in one chart list so that you can review what they're doing at the opening bell? I mean, I think this is one of the coolest chart lists that we offer. And again, it's free. Why wouldn't you want it? Let me show you, though. Let's get a quick update here and see what is leading. And we'll do percentage change. And SANM, the big one right now, up 28%. Electrical components. There's super microcomputer, SMCI, up right now. It's at 537. Let's take a look. It got as high as 554. So that was a quick $16 drop. And for many of you that have followed me at Earnings Beats for a while, and especially come into the trading room, a lot of times stocks that gap up do fill back to the prior day's close. So one trade that you can certainly put on, you just have to be careful, because I don't like to short in a bull market. But for those who are interested, a lot of times you can short stocks that gap up at the open and ride them back down. I mean, if I did that and I got a few bucks out of it, I'd probably take it and run. Because again, I don't like to short. I certainly don't like to hold shorts for very long in a bull market advance. But some of these companies that jump like this after already having a strong move, sometimes we'll see at least a little bit of weakness before it starts to move back to the upside, if it moves back to the upside. So that was one on SMCI. That is maybe, and we could look at the intraday on this one, by the way, because this is what I like to do. You can see it got as high as 554 and change. Currently now at 533. So it's now $20, $21 off of its high. We could probably get another quick update. And got down to 530. Now it's starting to come back up a little bit off the low. We'll see what happens. It's going to be very, very volatile here, probably for the first 30 minutes or so, especially with such a strong report. I wouldn't be surprised to see buyers jump in at some point, though. If you look at those numbers and the raised guidance, it probably is going to turn out to be one of, if not the best earnings report we see all season. Goes the other way, too. By the way, GM up almost 8%. MSCI in the specialty finance area, which is an area that's just recently broken out, looks good to me. MSCI coming out, jumping 7.5%. FFIV, one of the companies that I've talked about, showed a chart of, and I include every week in the weekly market report as one of those long-term charts that I really like. FFIV reported earnings jumping 7% this morning. Some pretty good action there, but let's look at what's not working. CALX, this is a technology company, down 26%. One of the strategies I like to use sometimes are companies that show relative strength. Here, you can look at the scooter. So here's a company, 85.9. That's a pretty strong scooter score. It's down 5%. It's in the industrials. This is a chart that I might be interested in. Let me just look and see what the chart looks like. I mean, we're uptrending, looks pretty good. Today's weakness is taking us down to the 20-day. One thing I like to look at, though, is the AD line. So let me see. AD line, not great. And what the AD line tells me is that if the AD line is strong, then if you understand how the AD line, how the formula works, it means that this is a stock that tends to close in the upper end of its trading range for the day. So when you see it down in the morning, if it's got a strong AD, it's telling you that the odds are probably greater. Again, not a guarantee, but we're looking for risk. And in this case, the risk would be on the short side, not on the long side. But I don't really like the AD line. I mean, it's coming up, but it's still way off the prior highs, even though price action is at new highs. So that's not really what I'm looking for. But anyway, that's one. But look at stocks that have, and then the other thing is, by the way, I would go back and look to see if they beat their revenue and earnings estimates, because many times companies will. They'll beat, and they've already made a move higher, and it's a sell on the news kind of a thing. So the other one that I saw down here was 85.9. We'll look at this one, then we'll wrap up. Hope Bancorp, another bank, down 2%. Again, this one's so-so. If we pull up that AD line, yeah, I'm not really seeing it here. And then going back to the relative strength, it's starting to roll over, probably at the slowest level versus the banks in about 2 months. That's not really what I'm looking for. I'm looking for leaders that are pulling back, strong AD lines, and then hoping to get a reversal. Kind of watching them throughout the morning anyway, hoping that the sell-off, extends down to a key support level, and then start looking for a reversal. When it reverses, jump in, keep a fairly tight stop to the downside, and hopefully, if you're catching that reversal, you can make a pretty good amount of money within 1 day. And that's the whole idea. But anyway, make sure you're an EB Digest member so you can at least get this chart list. We put this out there every day. I know Matt Townsend here at EarningsBeats does a lot of work putting these things together. And it's for the benefit of our EarningsBeats community. So make sure you check that out. And again, if you have any concerns, just go over to EarningsBeats and scroll down. And here is where you find that free newsletter. All right, that's it for me. Still not a whole lot of stuff going on here. Let's get a quick update, see if there's anything big changes. Yeah, not really. S&P, the small cap index, getting some of those earlier losses back, but pretty close to the flat line across our major indices. Anyway, that's it for me. We do have another webinar coming up later this week on Thursday. If you're not familiar, we do the January effect. We follow the January effect. It's an absolutely amazing predictor of how the balance of the year is going to go, depending on how January goes. And so on Thursday, of course, it's February 1st. January has ended. And so we're going to be having a webinar for our members at EarningsBeats to talk about what the performance in January likely means for the balance of 2024. So you don't want to miss that. That's going to be a great event. Again, you need to be a member for that one. But hey, we got a 30-day free trial, so it won't cost you a dime to come into our trading room tomorrow, to come to our event on Thursday. Really get a good flavor for the work and the research and the guidance and the education that we provide at EarningsBeats. Anyhow, that's it for me. Everybody have a great day. Happy trading.